As indicated in the last session, we will deal with the DCF or time value of money. That is the first and foremost or one of the fundamental concepts in finance out there, because we need to understand what is meant by time value of money, why is time value of money essential, where are we going to use this time value of money concept, and so on and so forth. Supposing I am going to talk with the help of some examples, as well as I have got a bunch of PPT slides, we will use the slides also. I am going to talk with some bunch of examples out there. Supposing I say that you are investing, I would say investing rupees 10,000 at the rate of 12%. What do we need to know? We need to know what is the future value of our investment. FV, nothing but future value. Because future value of your investment will be higher than 10,000 obviously. Why higher than 10,000? That will be basically this 10,000 rupees you are going to get back plus 12% of 10,000 plus 10,000 into 12% is what you are going to get back out. That is, what you are going to get back is 11,200 is what you are going to get back, typically the future value. The same thing, if I have to mention it in the form of a formula, the formula will be present value into 1 plus R. PV is present value, like FV is a future value, PV is nothing but a present value. 1 plus R, R is the rate of interest. That is all what I can present in the form of formula. I mean, we can just do it this way. Very simple, standard case. But I can make the case a little complicated. I will say that let us let us sort of say indicate that. Supposing I take the same example. I will say example number 2. You are promised that 1 year later you will be given $11,424 out. 1 year later you will be given $11,424. And your expected return from the investment is 12%. Imagine your expected return from the investment is, let us say, is about 12% out there. Let us look at your expected return is 12% out. That means I have two options. I know I invest in a particular fixed deposit, it is going to give me 12% at the end of 1 year. I know that, I have it ready. I have another option. He says that I will give you 11,424 1 year later. Now, you give me an investment in such a way that the return what you give, that is the difference between what you invest today and what you are going to get 11,424 is equal to 12%, that is your expected return. I would say the investment what you make today, that is the money you are going to get 11,424 is exactly going to be equal to that 12% out there. So, what is the amount that you would like to invest if you are expecting 12% return? Extremely simple in this particular case out there. I would basically say that my cash flow out there, C, divide by 1 plus the interest rate out there, that is what happens, 11,424 divided by 1 plus 12% out there is all that I will do in this particular case. That will give me a value of, I think you can calculate, it will give me a value of about 10,200. It will give me a value of about 10,200. That is to say, this is what we call it as the present value. This is what we call as the future value. Future is going to give you 11,424. Your R, expected return, is 12%. So, what is the present value of the future money you are going to get. The present value of the future money what you are going to get is 10,200 if your expected return is 12%. Sir, if the expected return changes, will the present value change? Yes, if it's higher than 12, then it will be lower than 10,200. If it is lower than 12%, then it will be present value will be higher than 12% of 10,200. Simple. How much are you discounting? That is what it is. Here I am discounting by 12%. This money what I am going to get. I can discount it by n number out there. I can discount it by n number. That depends on the expected return. In this particular case, I specifically said my option of an alternative investment that I have with me. The alternative investment I have gives me 12%. So 12% becomes my benchmark discounting rate. So I get this figure out there. So that is what we will see. Moving a step further from here, I would go in for the next one. That is what we call it typically as the net present value. Now, what is this net present value in this particular case out there? Supposing I say that net present value. What is net present value? Let us say, let me take an example. There is a debt instrument which is available with the present value of 9,500. Has a future value of 10,000. My expected return in this case is 5%. Now question is, should I buy this instrument or should I not buy this instrument if my expected return is 5%? Let us see how is it, whether I should buy or not buy. My future value is 10,500, agreed. I am discounting it. When I said discounting, I am reducing the value of the 10,200 as of today. This is the future value. How much am I reducing? I am discounting it at the rate of 5%. That is my expected return. So in this case, what happens? There is a cash outflow of 9,500 that happens minus. Now, there is a cash inflow that happens, that is at $10,000 is the cash that happens. Now, $9,500 I am paying as of today. This $10,000 I am going to get 1 year later. So, I want to know the value of it as of today. I want to know the value of it as of today. That is, I want it to be discounted to the value today. Discounted means reduced to the value as of today. At what rate? At the rate of my expected return. That is 5% out there. So, what happens? It will be minus 9,500 plus 10,000 divided by 1 plus 0.05, that is 5%. To the power 1, because discounting only for 1 year. That will be equal to minus 9,500 plus it will be about 9,523.81 point. That means what happens? There is a 23.81 positive NPV, net present value. Net present value is nothing but cash outflow and then cash inflow. The difference between the cash outflow and the cash inflow. Present value of the cash outflow and present value of the cash inflow. The difference between the present value of the cash outflow, which is the money that is going out, and present value of the cash inflow, that is future expected cash I am going to get, I am discounting it to the value as of today. The difference between that is NPV. If NPV is positive, the $10,000 or 10,000 rupees what you are going to get 1 year later, if given my expected rate of return is 5%, is worth about 9,523.81. Is worth about 9,523.81. The 10,000 rupees what I am going to get 1 year later, given my expected return of 5%, is worth about 9,523.81. Whereas how much am I giving as of today? 9,500. What is the value of what I am going to get in future as of today? the value of what I am going to get in future as of today is 9,523.81. So what happens? There is a 23.81 that is going to be, I am going to gain out there. That is where we call it as positive NPV, positive net present value. So what happens? Should I accept this? Should I buy this at 9,500? Yes, I will have to buy this at 9,500 if my expected return is 5%, because I will make a little more money than my expected return. So far what we have talked about is all a single period case. When it's a single period case, we all took it for 1 year, that's all. Whether it is net present value or whether it is even the previous examples what I did of what you call it future value, all these things, I've just done it for only 1 year. Let us look at a multi-period case out there. Let us look at a multi-period case. For example, let us take a person basically invests money. A person basically invests money of about $500 or 500 rupees at the rate of 7% for 3 years. What is the money that the person is going to have at the end of 3 years? It will be 500 into 1.07 into 1.07 into 1.07. So what is happening? Your return is getting compounded. How is your return getting compounded? Let us see that. The first year I have what is called as earn 7% interest. So first year, year 1, what happens? My investment is 500. Earnings, what I am going to get is 7% of 500. What is 7% of 500, Suhail? 35. So I am going to have interest of 35. In the second year, what is my capital? This 535 becomes my capital. That is going to earn 7% interest, that 535. What is the interest? What is the interest component?
37.45.
Pardon me?
37.45.
So for third year, what is my principal? 535 plus 37.45, that is 572.45. And this is going to earn 7% interest out there. And when this is going to earn 7% interest, what is the value, Suhail?
40.07.
40.07. So in net, I will have to get 572 plus 40, 572.45 plus 40.07. At the end of 3 years, I will basically get 612.52 is the money that I am basically going to get out there. So what is happening? It is getting compounded in the process. Is there a formula for that? Well, yes, there is. Basically, we can use a simple formula in that particular case out there. All that I have to do is 500 into 1.07 cube 3 years. That's it. Now I can twist this example a little more. How do I twist this example a little more? I will say that imagine a company is giving you a consistent dividend of 1.10 every year, and this dividend is expected to grow at the rate of 40% for the next 5 years. This dividend is expected to grow at the rate of 40% over the next 5 years out. So what is happening? It is giving me a dividend of 1.10. It is expected to grow at 40%. It is expected to grow at 40% for the next 5 years. So what is going to be the future value of this dividend? What is the kind of money that I am going to have at the end of 5 years out there? What is the money that I am going to have at the end of 5 years? Am I right? Edit again. What is the money that I am going to earn at the end of 5 years? That is, what is the dividend that I am going to have the end of 5 years, in the 5th year or at the end of 5 years. So, what is the dividend? What is the dividend that I am going to have at the end of 5 years? All year on year accumulated together, every year together. So, what is that? Very extremely simple. It will be 1.10 is what I am going to get. This is going to grow at what is called as 1.4 1 plus r to the power of 5, and then that is going to give me about 5.92 is the amount of dividend that I am going to have in 5 years out. So, what happened? Future value, compounding. So, we looked at future value, single K period. Future value, compounding. That is what I am basically looking. I am not discounting here, I am only compounding. I am not discounting here. Please note, in this case or even in this earlier case out there, I never discounted. Discounted means I did not reduce the future value to the present value. No, I have not done that. I am calculating the future value, that is all. Now, if you have to discount it, then you can very simply discount it. Then you can say 6.12.52, I am going to get after 3 years. What is the value of it as of today? If my expected return is 7%, then all I will have to say is 6.12.52 divided by 1.07 to the power of 3. That should give you basically the same money. So, what happens? I am discounting here. I am discounting here. Discounting means bringing the value of the next year to the value as of today. All these same things I have sort of depicted in the form of slides out. Time value of money, it is what I said. It is sum of the sum of money. The sum of money is worth. The sum of the money is worth more than the same sum that will be at the future date due to the earnings potential in the interim, etc. So, future value and present value, I took the same example. If you invest $10,000 at 12%, what is the kind of return? We did calculate that. We did talk about one period case, present value. If you had got promised 11,424 1 year down the line with the interest rate of 12%, your investment will be worth how much? 1200. That is what we calculated. We also looked at this, that is, supposing you say 9,500, you are buying an instrument which you are going to get 10,000 a year later. Expected return is 5%. Will you buy it or not? Yes, in NPV case, we solved it. We also looked at multi-period case, future value and compounding. We said that I didn't use the name. Of course, Sarla Mistry put $500 in a savings account in a Missouri Cooperative Bank. The account earns 7% annually. How much will she have at the end of 3 years? We did calculate this. The next one, growth rate, compounded growth rate. What will be the dividend out there? Basically, what are we looking at in this particular case? Future value and compounding. Same thing as I had explained in this slide. As I had explained in this slide out here. Year on year, it is getting compounded. Year on year, it is getting compounded out there. Year on year, it is getting compounded out there. So, in this particular case, if I use the slide, what is happening? There is initially you get 1.10 year 0. This is going to grow at the rate of 40%. So, what happens? Next year you get 1.54. This 1.54 is going to grow at the rate of 40%. That is where square. You got 2.16. This is going to grow at the rate of about 3.02, 40%. This is going to grow again 4.23 and it is going to grow 5.92, and that is what we talked about in this particular case out there. So, same thing what I talked to you in this particular case out there. In this particular case, what I basically talked to you, I said discounting. Let us take the same thing out there in this particular case. PVN. How much would an investor set aside today in order to have 20,000 5 years later at the current rate of 15%? how much should he set aside today? If his expected return is 15% and he's going to get 20,000 5 years later. 20,000 divided by 1.15 to the power of 5, because 5 years out there, and that is what he is going to get, 5 years discounting. So if he pays about 9,943.53, he will meet his expected return of 15% to get 20,000. So ideally what he should do, he should buy it at a price which could be possibly lower than 9,943.53. If he buys it at a price 9,943.53 lower than that, he stands to gain, because his overall return will be higher than 15%. If he buys it at a price above 9,943.53, his expected return will drop from 15%. So ideally what happens? This is your threshold. If your expected return is 15%, you can say maximum I can bargain till this point. I should go anything lower than that, I will take it, because gainful for me. My cutoff point will be 9943.53 out there if my expected return is 15%. There are 4 more concepts which we will talk about out here. They are perpetuity, growing perpetuity, annuity, and growing annuity. Now there are textbook definitions for all this. Let me use very crude, simple definitions out there. What is a perpetuity? Imagine I retire as of today. I am eligible for a fixed pension every month as long as I am alive. That means what? If I live for 10 more years, I will keep getting the same money. If I am alive for 20 more years, I will keep getting the same money. If I am alive for 30 more years, I will keep getting the same money. So what happens? It is perpetual. That is, it keeps occurring again and again. The same amount keeps occurring again and again and again and again and again, time immemorial, till my life. That is what we call it as perpetuity. Sir, then what is this growing perpetuity? Imagine I am getting the same pension every month. Government is announcing a DA. Imagine government is announcing a DA which is standard, hypothetically, on a thing that, which is standard set at 2% or 3% out there. So every year, the pension what I am going to get is increasing by 3% consistently, year on year, it is going to keep increasing by 3% till the last day I am going to get pension out. So what is it is a perpetuity. Perpetuity means lifelong. But it is also growing at a particular rate, 2%, 3%, 5%, 10%, whatever it is. That is what we call it as growing perpetuity. That is a stream of cash flow that grows as a constant rate forever. What is annuity? Stream of cash flows. I invest money in a particular fund. That fund says, for the next 10 years, I am going to pay you so much, constant. I keep getting that money every year for the next 10 years out there. That is what we call it as annuity. Fixed time period. Growing annuity. I invest money. They say you are going to get return for the next 10 years. But every year the return that you are going to get is going to grow at a rate of 5% or 4% or 3%, some obnoxious, some percentage out there. So what happens? Stream of cash flows that grows at a constant rate, but the time period is fixed out. Now why do we need all this? Supposing I say that you are going to get 10,000 rupees every year for the next 5 years, constant. You need to know how much you have to invest as of today. I am talking about annuity. How much is that depends on my expected return, my discounting. If my expected return discounting on my investment is 5% or 8%, That means how much I have to invest today so that I get consistent return for the next 5 years of 10,000 rupees. Annuity. Somebody can say, you invest some money now, I am going to give you 10,000 rupees, but for the next 5 years, not consistently. Every year it is going to grow by 10%. First year you are going to get 10,000, second year you are going to get 11,000, third year you are going to get 12,110 or whatever it is, and then so on and so forth. So, what is the money that you got to part with as of today? Growing annuity. Same case with perpetuity. You are going to get lifelong some money. What is the money you have to part with as of today? So, all these are essential for basically looking at any kind of investment option. Now, let us take some numericals, some numbers, as well as some basic what you call a formulae, etc., to arrive at all these things out there as we go on.